All right, let's dive right into this explainer. We're looking at how a seemingly invincible automotive empire, yeah, the Volkswagen Group, suddenly found itself literally fighting for its survival. Now, if you've been following the industry at all, you know VW has faced its share of headwinds lately. But what culminated in 2026 is nothing short of an existential crisis. This is a fascinating story of how massive historical success can sometimes mask deep structural vulnerabilities until, well, a perfect storm hits.
To really grasp the stakes here, we've got to look at the sheer scale of the situation. We are talking about a sprawling industrial colossus with over 667,000 employees worldwide. But get this, to avoid collapse in the face of shifting markets, management is actually contemplating cutting up to 100,000 jobs, and that is on top of 50,000 cuts they had already planned. So we're not just talking about a minor corporate restructuring here. This is an industrial giant attempting a profound and deeply painful reinvention.
Section 1. An Empire in Crisis. How the Giant Fell.
To understand the severity of this fall, we actually have to look at the incredible heights they reached first. Founded way back in 1937 to provide affordable mobility, they became the ultimate symbol of West Germany's post-war economic rebirth. But you know the real game changer? That was the 1980s. Volkswagen was one of the very first Western automakers to establish joint ventures in China, securing a massive first-mover advantage. For decades, those huge double-digit Chinese profit margins effectively subsidized the company's global expansion. It allowed them to snatch up premium brands like Porsche, Audi, and Lamborghini. By the 2010s, they were an absolute behemoth, routinely cranking out over 10 million vehicles a year.
But you know, all that massive success, it actually created a trap. With so much cash just pouring in from China, the company expanded into a remarkably unwieldy bureaucracy. They developed vast arrays of overlapping brands, redundant platforms, and dizzying regional variants. They essentially created a corporate structure where you probably needed a form just to request another form. And while this diversification seemed pretty smart during regional downturns, it quietly built up incredibly unsustainable fixed costs. When the market rapidly shifted toward electrification and software, that heavy bureaucracy left them dangerously exposed.
Section 2. The Profit Collapse. Vanishing Margins.
So, the crucial point here is this absolutely devastating mismatch. Before the pandemic, Volkswagen built out a staggering global production capacity for about 12 million vehicles annually. But actual recent sales? They've hovered closer to 9 million. That means factories designed for peak global output are now sitting heavily underutilized. In the auto industry, empty factory lines are a direct, immediate drain on resources. It creates an enormous fixed cost burden that just eats right away at the bottom line.
And the direct result of carrying that massive burden? It's severe. Operating margins have literally halved. In a recent quarter in early 2026, margins plummeted to a shocking 2.8%. I mean, we haven't seen numbers this low since the absolute depths of the Dieselgate scandal. This crash is primarily driven by incredibly high German labor and energy costs, combined with the massive, multi-billion euro investments required to transition to electric vehicles.
Which brings us to a really harsh reality for the boardroom. Financial analysts have pinpointed what they call a growing mismatch between investment needs and cash generation. So what does this actually mean for us? Well, Volkswagen desperately needs cash to fund battery technology, software development, and next-generation EV platforms just to stay relevant. But their traditional profit engines are stalling out. This cash crunch is terrifying because it threatens to delay the very technological upgrades they need to survive.
Section 3. The China Catastrophe. Losing the Profit Engine.
Just looking at the raw numbers here, it is absolutely staggering. Volkswagen's sales in China fell by roughly 1/3 compared to 2019 levels. For a company that relied on China for decades to fund its global ambitions, this is catastrophic. And it gets worse. The profits generated from those Chinese operations have collapsed by over 80% in the last decade alone. The era of China bankrolling Volkswagen's global empire has ended with shocking speed.
And the reasons behind this rapid shift are pretty clear when you look under the hood. While VW was busy developing its legacy ID Electric series, they were really hampered by older decision-making processes. Their cars suffered from software glitches, higher pricing, and painfully slow updates. Honestly, they felt a lot like electrified versions of older combustion cars. Meanwhile, domestic Chinese rivals like BYD and NIO were incredibly agile and vertically integrated. They offered ground-up electric experiences with superior software and significantly lower prices. So the Chinese consumers simply moved on to better, cheaper, local technology.
Section 4. The 2026 Survival Plan. Blueprint for Survival.
Facing this enormous structural shift, CEO Oliver Blume presented a radical blueprint. Management finally realized that prior cost-cutting programs just weren't going to cut it anymore. This 12-point future plan is an aggressive attempt to slash complexity across the board. They're proposing cutting their model lineup by up to 50%. That means taking their 150 different model lines and chopping them in half to focus only on what's actually profitable. They are deliberately reducing their global capacity target to match the reality of 9 million vehicles, and they're going all in on massive reductions in platform complexity and overhead.
But to actually execute this plan, we have to cross a line that has never been crossed in the company's 89-year history. They're discussing the potential closure of 4 domestic assembly plants right in Germany: Hanover, Zwickau, Emden, and Neckarsulm. For a company whose headquarters in Wolfsburg functions almost like a company town, the idea of closing domestic factories is a massive political and cultural earthquake.
And that brings us to a massive core conflict of priorities. It's an intense clash. On one side, you have management arguing that deep structural cuts are absolutely necessary for long-term survival and competitiveness. On the other side, Germany's incredibly powerful labor unions, like IG Metall, argue that these cuts will completely devastate local communities. They're pushing instead for social protection, retraining, and shorter work weeks. Finding a compromise between global corporate competitiveness and the traditional German social contract is proving incredibly difficult.
Section 5. The road ahead. Industry implications.
What we are witnessing here is a true structural reckoning. Make no mistake, this isn't just a cyclical economic downturn that's going to bounce back in a few years. It is a permanent shift in the landscape. Legacy automakers are suddenly caught between the outrageously expensive transition to software-defined vehicles, fierce competition from heavily subsidized Chinese manufacturers, and super strict EU compliance rules regarding emissions and data. Toss in global geopolitical headwinds like US tariffs, and the traditional business model that built the Volkswagen empire is fundamentally broken.
So, for Volkswagen to survive and reach its goal of becoming the most attractive automotive company by 2030, they absolutely must flawlessly execute 3 incredibly difficult steps. Step 1, they have to actually pull off those severe complexity cuts without destroying their core brand identities. Step 2, they must successfully negotiate the workforce adjustments with the unions without sparking crippling strikes. And step 3, they have to take whatever cash they save and use it to rapidly regain technological ground against their EV rivals.
Ultimately, the one thing we know for sure is that inaction is no longer viable. The whole world, from competitors watching closely to the hundreds of thousands of employees whose livelihoods depend on it, is waiting to see if this post-war giant can successfully adapt to a new reality, or if a slow, painful contraction is inevitable. It really is the ultimate test of an industrial empire. Thank you so much for joining me for this explainer, and for more, visit our website, Fair Solution.